Okay, so today I'm actually going to take a look back at a company that we've had under coverage at Keystone for several years now. And this company is goeasy Limited. The symbol is GSY on the TSX. It's trading right now at about $103, $3 billion market cap, and about a 2.6% yield. So, what they are is they're an alternative financial services company. They primarily serve non prime or subprime borrowers in three main business units. There's Easy Financial, their largest unit, which offers unsecured and secured loans, Easy Home, which provides lease to own furniture and appliances, and also LendCare, which offers point of sale consumer financing. So this company has performed very well over the last year here, over the last 12 months. As I said, about $183 right now, up from 120 12 months ago. Our coverage at Keystone on goeasy has gone back for over 5 years. So it was in May of 2019 that we originally recommended this company at a price of just under $50 per share. It's performed spectacularly well since that time. There's been some volatility around the 2002 period. A lot of that having to do with concerns about rising interest rates and how that would affect a company like goeasy being in the finance industry. But companies continue to perform well. So the reason why I want to talk about goeasy is we recently talked a little bit about some research that was done on the stock market and what are the contributing factors to excessively high returns relative to the market from companies. And the main factors tend to be companies that are profitable and that are growing their earnings per share. So when we first looked at goeasy 5 years ago, I'll have to admit, back then I had followed the company for a couple of years and I kind of dismissed it because I felt that the business of non-prime lending, unsecured lending was just too risky and I didn't really understand it, didn't want to be in it. But as I learned more about the company and looked at the company's track record, I saw something that was extremely compelling. And this is a company, first of all, it's a very entrepreneurial focused company, high management ownership. But this is a company that has got an almost unparalleled track record of financial success. So we looked at the company's financials going back 20 years. In every year, so for 20 straight years, the company was able to achieve revenue growth. And they were also able to achieve profitability consistently over that 20-year period as well. So we looked at how the company essentially was able to deal with shocks to the market. One of the biggest ones in this period being the 2008 financial crisis. And goeasy, based on the way that they managed their business, the way that they managed their risk, was actually able to maintain profitability through this period. So earnings per share did decline moderately during the financial crisis, but still strong profitability. And the financials were also very quick to rebound. So track record is something that we look at. Not every company is going to have a 20-year track record. Some companies are newer, and that's okay. It's not necessary that they have a 20-year track record. For some companies, there may be a change in their market, which is going to impact their financials in the future relative to how they've been in the past. And it's important to understand that. So there's a lot of factors that go into researching and recommending a company. In the case of goeasy, we were talking to management, we were looking at the track record, but also what was happening in the market at the time in 2018. So it's pretty phenomenal, though, that they were able to, given the business that they're in, maintain their profitability over this period of time, and then again maintain the revenue growth. So right through the financial crisis, they were able to maintain their growth as well. And there have been other crises over this period of time as well. More regional shocks. There was the downturn in the oil industry in Alberta. They've experienced a couple of those. But through that, the risk management process is really what we were looking at, and that risk management process was able to avoid a lot of the, what a lot of people would have expected would happen to a subprime company at the time. And they were also able to gain market share, given that they were in a strong financial position. So this is really what the base of our investment strategy at Keystone. The first thing we look at for any company, it doesn't matter the industry, it doesn't matter the theme, the trend, is this company profitable? Is there a significant amount of profitability and free cash flow coming from the current operations? And that is the very baseline, bottom level criteria for investment. If a company doesn't pass that test, then it's not something that we're interested in pursuing, even on a research basis. And then beyond that, we want to see that the company is able to grow their earnings per share, their revenue per share, and also do this without incurring too much debt. We want to understand the business model, the growth prospects. It should be an understandable growth plan that has a high probability of success. So these are the things that we looked at with goeasy. Now, since then, since 2018, the growth had actually accelerated. So 2018, it was about $3 per share in earnings. Last year, they made 14 per share in earnings, but consistent growth since that recommendation based on this growth strategy that I talked about in the research. And this growth is expected to continue in 2024 with analyst estimates in the range of about $17 to $18 for earnings per share right now. So growth is expected to continue. Looking for the key growth drivers of the company would be continuing to do what they're doing with the risk management and the customer service to gain more market share in the unsecured lending space. But they've also more recently entered into the automotive financing space. So that is a large market and a big area of potential growth for them. They've also come out with a new general purpose credit card. It's in development. It's not out yet, but this is in development. And this is supported by the goeasy Connect mobile app. So good, strong, long-term growth drivers going forward. But another thing that I want to talk about with goeasy that made it attractive was the dividend. So the company did not pay a very high yield at the time, roughly around where it is right now. So I think it was about 2.5% when we recommended it. But just as the earnings and the revenue were growing, so were the dividend. So that growth in earnings allowed them to continue to increase the dividend and consistently over this period of time. So in over a 6-year period, they've been able to increase their dividend by a multiple of 5. So the current dividend this year is expected to be about $4.68 based on the increase at the start of the year, compared to 90 cents per annum when we originally recommended it. So about 5 times growth there. And we expect that to continue, perhaps not at the same pace. The growth may slow somewhat, but we are continuing to target consistent annual growth in the dividend over time. And what we're really looking at, I mean, if you extrapolate this going forward, even at a lower growth rate in 5 to 10%, like just looking, our original recommendation price on the company was $49. It's now paying a yield of, close to $4.70 right now. So that's almost a 10% yield on that original entry price. And this is really kind of the way we would look at dividend pairs. I mean, we want to see a company that's paying a reasonable yield and growing that dividend over time. Now, sometimes they're starting with the higher yield and the dividend growth, while consistent, maybe more in the single digit range. Other times you're investing in a company that has a relatively small yield, but they're growing it in the double digits, basically on an annual basis. So, but really it's dividend growth that we're looking forward to drive the performance for a lot of these companies. So just in terms of investment thesis on goeasy, it's a high growth specialty company with an unparalleled track record, 20 plus years, 90 consecutive quarters of profitability. They're maintaining their positive outlook for double-digit revenue growth in 2024 and 2025. They're also looking at continued margin expansion. They did a fantastic job. I mean, recently they've had to contend with the increase in interest rates. That has been a significant net negative for most finance companies, but they've continued to be able to grow through that. So that is, again, attributable to the risk management, high insider ownership, which we like when management is aligned with shareholders. It's about 23% insider ownership, and of course, trading at a reasonable valuation. So excellent track record, strong growth, strong profitability, trading right now in the range of 10 to 11 times expected 2024 adjusted EPS. So we continue to like the company. We continue to have coverage on it, and we will be putting out an update on goeasy when they come out with their Q2 results in August.
That's definitely, thank you, Aaron. That's a good summary on goeasy. Again, like we've said, it's a company we've had in coverage for a number of years, and I think you went through the business and the growth in the business. And one of the things that we kind of try to impress on investors is it has been a dividend growth stock. So the effective yield has gone up over time, which is great to see. But it's really the share price gains, like the appreciation, capital appreciation, this appreciation that you see it in goeasy. And it's, people talk about you to gain exposure to financials in Canada. You talk about having the big banks. Most Canadians invest in, the big banks. They own. We see many portfolios they own 4 out of the 5. You don't have to do that, but there are other financial services companies in the Canadian markets. goeasy is one of them. We have one that has had a tremendous gain for us in our portfolio over the Canadian small cap portfolio. It's a bank and it's just entered the US market. And it had a good day as we're recording this today. Again, not many investors know about that business. Not many actually knew about goeasy, particularly 5-10 years ago. But great businesses that are kind of outside. They're in the financial services sector, they're in the financial sector, but they're not the big banks, and they're outperforming the big banks significantly. So while we own maybe one of the big banks, there's the sixth largest bank we have a recommendation on too as well. But there's companies kind of that you get less coverage on, that you come to Keystone, you're going to get more coverage on those companies. And we're looking for outperformance in terms of those. And, all three of those companies have outperformed the big banks over the last 5 to 10 years. And that's what we like to see.
When you're looking at really any subprime financial company, people always are, oh, it's too risky. It's going to just blow up. But then when you do have companies which can do it well, they can structure their risk and they can manage that well. This is why you get those returns, because they're able to get those higher returns off their loans and lending activities versus then if they don't realize that risk, that's why you get that compounding, even if it's only squeaking out an extra percent compared to a bank model. Once you're
Mm-hmm.
going over 5-10 years, it just multiplies drastically.
Yeah.
Yeah,
And yeah, go, Brennan.
all I was going to say is just again reiterate, what Aaron was saying about like the effective yield. It's paying just slight of a 10% effective yield now for people who bought it on our initial recommendation, which was slightly under $50. And when we did initially recommend it, it was paying a forward yield, I believe, about 2.5%. So
Yeah.
again, just holding it, since 2019, which really isn't a long time ago, you're
No,
now
no.
making about 10% on your money every single year, as long as you still hold the stock.
Yeah, and we expect that to continue to go up over
Yeah.
time. That dividend will increase, probably besting, the rate that you see an increase at a bank or the big banks. And of course, you've seen it go from $50 to 190 plus.
Hmm.
So, there's your real gain.
Yeah.
But you're also, if it stays flat for a year, you're making, on the effective yield on the original investment, you're making 10% every year, which is excellent to see.